Good morning. A very warm welcome to the fourth in the winter series of the Financial Fitness Fridays. I think it's very apt that this is the last of the winter series because I think the weather's looking good this weekend, so the sun's going to be out. I think there is light at the end of the COVID-19 tunnel. I do feel the mood's lifted, and I'm sure a lot of you would agree with that. So just a bit of housekeeping for today. The session today runs for 30 minutes formally. I've got a guest. I'm going to tell you about the guest in a moment. And then I'm going to ask the guest a lot of questions. The topic today is tax. Okay, now, because tax isn't the most exciting of subjects, it can be a bit dry. In order to try and make it a bit more interesting, obviously we've got the budget a couple of days ago, so we could talk a bit about that. But I've chosen my guest very wisely. So I've chosen a guest who's a bit lively, so it should be a bit of fun to try and make a dry subject relevant and useful for you. So what we're going to do, we're going to go through for 30 minutes, no more, and then we're going to end it formally. If you would like to stay on, then what we do, we'll formally close the session, but we'll stay live, and then we're going to answer questions. So if you do have questions, then all you need to do is in the Q&A or in the chat box, just put your questions, and we'll let those mount up over the half an hour. And then at the end, what I'll start to do is pull out some of those questions. I'll ask our guest, Grace, to answer some of those questions. Any questions that are a bit personal, then what we'll do, we'll pick those up separately. But any questions that will benefit a group of people on this session, then we'll ask those questions, and we'll definitely end by 45 minutes, quarter of an hour in. Okay. So the Financial Fitness Fridays, for those of you that have not been on this before, the idea was born out of Joe Wicks and what Joe Wicks was doing last summer. He was doing that Joe Wicks fitness session. So we thought, well, why don't we get our sweat on with financial fitness? It's really important. It's come at a really good time. And this is, I think now this is probably about number 14 or something we've done. Just to let you know, if you want to see some of the previous episodes, you can go to the YouTube channel. If you go to YouTube and then search Financial Fitness Fridays, then you'll see all the ones that we're allowed to put on there that we have to approve them because we're a regulated organisation. So they're approved all the time. If the rules change, such as a new tax year or something, then they'll be taken down. But most of them are on there, and we just keep reapproving them all the time. So go on there and have a little look. We're also going to start to do some podcasts as well. So whether they're video podcasts or audio podcasts, to try, because I can do a load of those in a whole day. The Financial Fitness Friday session, believe it or not, the session today, the Friday, it probably takes up a day of my life because we have to pick a guest, pick a subject, we have to then build the whole thing, we have to get it regulatory approval and rehearse it, all those sorts of things. So it's a lot of work in one half an hour. So the reason we're doing tax today is because we ask you to give us feedback. And the feedback we've had from the past is people want to know and understand their tax situation. It's a bit confusing for some people, so we're going to try and make it nice and simple today. We're going to talk in plain English, and as you'll find out, Grace is a very straight-talking person. I know Grace really well. We've been friends for a long time, so if there is a bit of banter, don't be offended. It's just there's a lot of rapport between us. Okay. So at the end of the session, what we do need you to do, please. When you come out, you'll be taken to a feedback survey. Give us some feedback. Tell us what you liked. Tell us what you didn't like. Tell us what else you would like to see, what improvements we could make, and what other subjects and topics you would like for future sessions. We'll be doing a spring session, a summer session, and an autumn session. We tend to pick 1 month in that quarter, and we do the 4 Fridays in there as well. So talking about taxation, and obviously I always come at this from a financial well-being perspective. And as Mark Twain said, he's famously quoted as saying, there are only 2 certainties in life, and that's death and taxes. And we can't control them, but we can have a lot of influence on them. And certainly with taxes, we have the right to organise our affairs to pay the minimum amount of tax within the rules. So that's our right to do that. And it's fair to say that most people do not take advantage of all the tax reliefs and allowances that they are entitled to. So just imagine if you did, for the whole of your life that you took advantage of all the tax reliefs and allowances that you're entitled to, and that money that you saved and you use more effectively, you use that to build your wealth. Can you imagine, 10, 20, 30 years down the line, and how much better off we will be. So what we want to try and do today is dispel a few myths and give you some confidence. Knowledge is power. And if you understand what's going on, you have a bit more knowledge, then you feel more in control. And from a financial well-being perspective, more control, feeling in control means you don't get so stressed and so anxious. And what we would like to do is to help everybody avoid any nasty surprises. There's nothing worse when you get that brown envelope in the letterbox and you get a tax bill that you weren't expecting. So there are ways, taxation, we can control it and manage it a wee bit. But the other side of it is just knowing what's going to happen, knowing what's around the corner, being prepared for things. So it's not just about paying less tax. It's about understanding the system and understanding what might happen. So obviously, as we go through the different topics today, there is going to be a reference to the spring statement that we've had with Rishi. So we'll interject some of those things. So plain English, simple to understand. So I'm going to introduce our lovely guest, Grace Agnew, who is a regulated financial advisor from Foster Deliver. So hello, Grace. Are you there? Can you reveal yourself?
Hi, Darren. Yes, I'm here. How are you?
Yeah, brilliant. You've got a much nicer, colourful background than I have. Thanks very much for helping us out today. Really appreciate it.
No problem whatsoever.
You're not feeling nervous now, are you?
No, I'm not actually, because I can't see anyone. Makes it a lot easier.
Okay, brilliant. So I'm going to ask you a bunch of questions. You sort of know a rough outline of the questions we're going to get. When we get the questions from the audience, certainly that will be putting you on the spot time. So we'll see how you get on. Brilliant. So now there seems to be taxation at every corner in life that we go through. There's income tax on our income. There's capital gains tax, or CGT, as people call it in our industry, which is tax on our investments. And then there's inheritance tax, which is probably the least popular one, which is where we pay taxes on the wealth that we've created throughout our life. But I want to start with income tax, because we can talk about the spring statement as well. But there's, things like tax codes. I hear it all the time through the financial education work that we do. We hear about it all the time. People don't understand their tax codes. So could you just, in very simple English terms, could you just explain tax codes for us, please? Thanks very much.
Okay, I'll do this as simply as possible. It's something that you get given from HMRC, and it's got in relation to what pay rate you're on. So, for example, do you want me to give you an example of some of these codes and what they mean?
Well, I've got a code on a payslip, 125L.
125L. No, that's not right, because that says you're younger than 65. So that's
not my payslip.
No, you're self-employed. You're self-employed, so it's different. But it tells your employer how much income tax should be taken from you. So different people have different tax codes, because some people earn less, some people earn more. So that's what it does. So a lot of times people get confused because they're on the tax code, and that's something that needs to be sorted out, obviously. So if the best one for you to be in, I suppose, is DO, because it means you pay higher rate tax of 40%, well, that's a lot of tax to pay. But if you have that on your statement, you're quite lucky. NT, you have no taxable income. So there's a lot of different abbreviations, and I'm happy to go through these for your individual circumstances. But
so let's take one example. If I look at a pay slip and I've got a number on there, what does that number mean? So like 125 on a pay slip, is that the personal allowance, 12,500?
Yeah, that's the personal allowance that you're entitled to a net tax share. So and then you've got the other letters that come on the end of it, which confuses people even more.
Okay, so if I've got BR.
BR stands for basic rate taxpayer.
So
you wouldn't know that if you were in the industry. So that's 20% tax.
Okay, so basically the code is effectively the amount of money I can earn before I pay tax.
Yes, that's exactly it. But you need to make sure it's the right code, because quite often it's the wrong code. So it's something very important. You won't really be taxed at a higher rate amount if you're a basic rate taxpayer, for example. But that's not fair. You'd be taxed double.
Right. So in the spring statement, Rishi, he has, I think he's increasing the personal allowance a little bit.
Whole £70?
£70. Okay.
It goes from 12,500 to 12,570. That's
So
because it's a nice meal out, isn't it?
So we're supposed to be, there's supposed to be more tax coming so that we can pay for the pandemics, the bill that's been racked up, billions of pounds of bills. So people are talking about a stealth tax on income. How does this work?
Well, basically what they're doing is they put a freeze on the rates increasing, which is quite interesting. So they've said that until April 2026, the rates of income tax, the basic rate tax and capital gains tax and the inheritance tax are all going to be frozen. So essentially what that means is if you earn more money, which hopefully you do if you've got a good employer that pays you more, you'll be paying more tax because those amounts aren't going to go up every year as they generally do.
Okay, so I think it's going up £70 and it's being flat for 4 years, isn't it?
Yes.
Yeah.
And the same in 2026. So
and what's the higher? So when we go to the higher level of tax, so that's 20%. What about 40%? When does that kick in?
That's 50,270. So that's been more generous at an extra £270. But
so as people's income goes up, we move into those thresholds, and then their tax rate will go up.
Yes.
So the percentages are staying the same.
That's exactly it. So they'll be the same, and they always come up with strange and odd figures for these things. If you remember, so the 5270, as soon as your income's over that, you'll start paying 40% on that bit, not on the whole lot. Some people think it's a whole lot, but just on that bit over. And then if you're really lucky and you earn over 150,000, that goes up to 45% tax rate.
Oh, if you're lucky. If you're lucky enough to be at that height. Okay, so the stealth tax then, so I read something and it said that 1 in 10 people over the next 4 years will be paying the high rate of tax.
Well, yeah, if they're earning enough, definitely.
Yeah, so that's people creep up.
Yep. Yeah.
So I suppose the good thing about it is that rather than if the government applied a higher rate of income tax to the actual headline figure, we would all feel it immediately, wouldn't we?
Yes. Yes.
Whereas the way he's doing it is that we don't feel it straight away. We only pay more tax at exactly the same moment as we get a bit more pay.
It's quite interesting actually, because a lot of the things, the commentary has been saying that this budget has been a spend now and tax later budget, which I think is definitely the case, because people are going to be feeling the effects of tax later on, especially if your income goes up. Definitely.
Okay. So I think when we get onto it, we'll get onto inheritance tax in a bit. I think there's a similar thing going on there, but it's a really extreme example we can share. So basically what we're saying then is that the thresholds are pretty much the same. They've gone up a tiny amount, 21 for 21, 22. And then the next 4 years are going to stay flat. And then as our income goes up, we'll be pushing ourselves into the higher rates. We'll be paying more tax in terms of pound notes, same percentage. So the tax take will go up. Okay. But the good news is we only pay more when we earn more. We're not going to see a take-home pay ever go backwards because of tax.
No, well, in effect, if you're earning more, that's a good thing as well, isn't it? So, but pay more taxes, obviously, but.
Okay. And so how could somebody pay less tax right now?
In terms of tax saving things, we've got pensions that you can obviously use, which some people love and some people hate, I'm going to be honest, because you can't get access to your money for a while for that. But immediately you get a 20% tax relief on that going in. And
what happened with tax on pensions in the budget?
With the pensions in the budget? Oh, that was frozen as well. You mean the lifetime allowance? There was actually no real changes there, apart from lifetime allowance is frozen, which means they'll get more tax for people that have more money in their pensions. But there was a lot of talk around, and there's always talk about this, to getting rid of the high rate tax relief and pensions and getting rid of tax-free cash, and that didn't happen, which a lot of people are happy about, especially people that earn a lot more money. So yes, they've still got the base rate tax relief. You still get the higher rate tax relief, that unless you do through salary sacrifice, you need to make sure you claim back. So you've still got those reliefs. So that's why pensions are good. So if you put money into that, you automatically get 20% uplift, which is a good thing. Okay,
so let's put that in English. Okay, so if I pay £80 in my pension,
£100 goes in. So
right.
this is something that people always get confused on, because there's a net and a gross figure. So the net figure is the amount you physically pay from your bank account. The gross figure is the amount that is with the tax relief. So that's the £100. Now, for high rate taxpayers, this is very important for you to note, because a lot of people fill in their tax form wrong. When they ask you for the figure that you pay in your tax return, you need to quote the gross figure, not the net, or else you're not going to get as much back. It's happened to so many of my
That's a really important point. So
yeah.
on self-assessment,
Yep.
people need to put in the gross amount into their pension.
Definitely, without a doubt, because
For
the
what
way
reason?
it's worded, it looks like you would think, how much do I pay? I pay £80, but it's actually the amount that goes in is 100. They want the gross. You get 20% extra on for the high rate relief of 40 altogether on the gross amount. So yeah, it's really, really important for people to do that. And if you haven't, go back and do it. You can go back 4 years and do that. So it's really important.
So I think the pensions tax relief was untouched in the budget, and I think a lot of people were expecting it to be tinkered with,
yes,
as an easy way to get some extra tax revenue.
Mm-hmm.
So what's your opinion? I know it's only an opinion, but what's your opinion on the longevity of this being untouched?
They always seem to touch pensions. They always seem to raid the money from there and do something with them. And the lifetime allowance freeze is a testament to that, because people, especially I read things, people like doctors and the NHS have got lots of money in pensions, so they're hit by this huge tax they get.
So what is the lifetime allowance?
What the lifetime allowance is the amount of money you're allowed to put into pension before you're over a limit, before they tax you. So they tax you an additional 55% over that amount. So say the lifetime allowance is it's 1,000. How much is it altogether? £1,073,100. They never make it an easy number. So anything over that, when it's taxed at a 55% tax charge. If it's 200,000, it can be taxed at 55%. So a lot of people get concerned about that, and a lot of people naturally, from their investments doing well, can go over that quite easily, and with contributions from their employers. So
okay, so you've got the contributions into the pension. So it's not how much they pay, it's about how much the total fund reaches.
Yeah, the value at the end of it. So, but that can I've had a few clients, especially doctors and dentists, who have been over this just because the amount that's been paid in, and they don't know what to do, and they've had to take advice on it actually. But generally, paying 55% of $500,000 is better than not having that $500,000. So that's a difference.
But it's 55% tax on that.
Over the amount over.
Wow.
Yeah.
So
and if you don't take your pension, they test it at age 75 for you.
Right.
Because pensions are free of inheritance tax. So a lot of people will just leave them there and not need to take them. They'll just do that.
So it's probably worth somebody, they think that's going to happen to them, probably worth getting some professional help.
Yeah, definitely. A lot of people don't really think about it, and they don't even, actually a lot of people don't think of their pensions until real money, until they actually come to the point they need to take them. I don't know what, I think they think they're going to disappear. So if they've got $500,000 in a pension, I think it's because it's not tangible. You look at a property $500,000, you can see it. You look at a pension $500,000, it doesn't sometimes seem real. And I think that's got to do with people not understanding them properly either.
Okay, so bottom line is, I think what we're saying is pensions are untouched.
Yep.
We get all our tax back by paying money into our pension. There are certain people with very high earnings who don't quite benefit as much, but I think that's the minority, massive minority. But certainly you get all your tax back, whether that's 20% or 40%. There's $1,073,000 that you can have that is your lifetime allowance. Probably pensions will be tinkered with again in the future. Possibly a lot of talk about flattening the tax relief rate for the contributions. So probably if someone's thinking of saving extra into their pension or putting a lump sum in, probably sooner rather than later might be a good idea.
Yeah, definitely, because if the high rate tax relief is going to go, that's something that's 40% you're missing out on that you could have had. And also if there's always talk about the tax-free cash element going to the 25% tax-free cash. So
okay, so I'm just conscious of time, so let's jump on to capital gains tax. Now, I know a lot of people don't quite know what this is all about. So who does it affect and how is it paid?
Okay, capital gains tax, to try and simplify this for people, I think most people understand what a personal allowance is. That's the 12,570 you get tax-free. What a lot of people don't realize is they've also got another allowance, and that's in relation to capital gains tax, which is 12,300 tax-free for an individual. With capital gains tax, it's an interesting one because most people who own their own properties, you don't pay any capital gains tax on that in your main residence. But a lot of people, what they don't realize, they buy all these rental properties and then they sell them. They hit with this big capital gains tax, which can be 18 or 28%, depending on your tax rate. So that's another tax collected by the government, but you do get that exemption of 12,300 per tax year for that as well, that you need to be aware of. But it's
So what happens if you don't use it one year because you don't sell the house, for example? Oh, right, okay. Okay, so that's...
It's just like the personal allowance, you get it that tax year.
Okay, and is there any way that people can invest outside of pensions where there's no capital gains tax?
Yes, you can put money into ISAs because they're free of any income tax and any tax on the growth. And even better for people out there, you don't have to put it on your tax return. So a lot of people love that. A lot of people love that because it's one less thing to worry about. The issue is, especially with what's happened at the moment, a lot of people have saved a lot of money into cash ISAs. And cash ISAs, I'm not sure if everyone knows what the rate of inflation is at the moment, consumer prices index. At the moment, it's for the month of January, actually, it's 1.8%.
What's that?
The rate of inflation.
All right.
For the whole of last year, it's 0.8%. The reason it's gone up so much, in 1 month it was 1.8%, is because of the increase in costs to transport and recreation and leisure, which is quite interesting. So if you've got things sitting in cash ISAs and your interest rate's not more than 0.8% or the 1.8% extreme example, you're actually losing money because the purchasing power is gone down.
There is a previous Financial Fitness Friday where we talked about this, where it seems the vast majority of people with ISAs have it in a cash ISA.
Yeah.
There's another option within the ISA called a stocks and shares ISA.
Yeah.
And I think what happens is people are a bit scared.
Yeah.
Stocks and shares feels like a big step away from cash. And so why do they do an ISA? Because it's tax-free, gross tax-free. But if it's in cash, tax-free growth on very, very little growth is very, very little tax relief.
Exactly.
So it's having that confidence to switch over to the stocks and shares ISA and actually change the language. It's an investment ISA.
Yeah.
And, if you're going to invest in it for 5 years or more, then probably the right place to invest it.
Yeah, and what people don't also realize about it is you can swap them. So a lot of people when they're younger might start with investment ISAs, and then when they get older and they're close to retirement want to de-risk it, and they can change it back to a cash ISA. So you can change them about, which is quite interesting, and that doesn't affect your ISA allowance for that tax year either because of previous years. And that's another thing that hasn't been changed. The ISA allowances are still 20,000 per tax year. So there's a lot of busyness in the office at the moment because of that, and the junior ISAs are 90,000 per tax year. So that's also remained unchanged.
Okay, so again, I'm conscious of time. It does go very quickly when we're doing this.
Actually, it doesn't.
I know. We need to talk about inheritance tax.
Yep.
So who pays it, how and when and how much?
Well, I'll just give you a couple of interesting statistics here for the overall listening population. The amount of money that the government actually received last year from inheritance was 5.2 billion, which is a lot of money. And you think there'd be a lot of people paying it, but actually it was only about 4% of the UK population that paid that. So a rough figure is about 25,000 people. So it just shows you how much money that they're getting from that tax. Now, inheritance tax has been the same rate. It's also, you get an allowance for that of 325,000, but that rates remain unchanged for the last 10 years. It hasn't increased at all.
Let's just clarify that point. So 325,000 is the allowance, which is what that means is that's the amount of money somebody could pass on with no tax.
Yes, and that's if you're married, or I have to say in a civil partnership, you've got 325 each, so that's 650 between you, because there's no IST between spouses or civil partners.
What about this thing to do with private residence?
Yes, this is a complicated thing that George Osborne added on. It's called the residence rule nil rate band. So what that's got to do, it's got to do with your main residence. So what they've said is if your property is worth up to over 2 million, let's pretend it's under 2 million, because over 2 million there's a taper and you might not get it. So say your property was worth 1 million, you essentially could get another 175,000 allowance each. So that means you're up to 1 million. But in order to get that, you have to be careful. In order to get that residence nil rate band inheritance tax thing.
So it's called a residence nil rate band.
Yeah, residence nil rate band. So you need to pass on your property to what's called a lineal descendant. So what we mean by that is somebody that's in your direct line family. So if you've got like your son or daughter, you're passing on to them. So it needs to stay in that situation. So there's rules and regulations around that.
Okay, so that's a little extra thing that was been brought about a few years ago because of the surge in property values. And you mentioned this 325,000. This is the nil rate band. This is the amount of money that you are allowed to pass on with no tax for ordinary assets. It's quite interesting. I remember that. In the spring statement they talk about that. When are they looking at reviewing that in the spring from the spring statement? What do they say?
Well, they said that they're going to leave it the same, didn't they? So they were going to review it. They were going to put up a little bit, but then they said no. We're just going to.
Right. Okay. So I've got a budget summary here. So I think it says that that's going to remain the same until 2026.
Yeah.
Now, interestingly, it also says that was set in 2009. So what we've got.
Yeah. Should be at least double what it is today, because house prices have gone up so much, and particularly in London, that amount 325 should be at least 650. But unfortunately, it hasn't been increased, and it should be a tax on the very wealthy. In London, if you buy a property, you're basically in that, and you don't have a mortgage, you're really in that zone, unfortunately.
So what we're looking at here is a really good example of a stealth tax. So we've got a nil rate band of 325,000 set in 2009 and not set to be reviewed in 2026. So the amount of money that somebody could pass on to their whoever when on death, we set at 325,000. It's going to stay there for 17 years at the same level.
Yeah.
Behind the scenes, properties and other assets are growing well above that. So the rate of inheritance tax is what is it? What's the tax rate on inheritance tax?
40%.
40%. So 40% on everything over and above that. So the headline rate hasn't changed, but the amount of money in the family estate that 40% is going to apply to is massively increasing. And in fact,
and what we find with a lot of clients in particular, as they do a bit of the ostrich in the sand thing with inheritance tax, so they don't think about it until it's too late. And I've had a lot of clients that have had, say, for example, they bought a house for 50,000, it's now worth $1 million. They don't understand that they're actually caught up by this quite easily, because they don't look at how many years you've had the property. They don't care. They're just like, well, that's worth that now. Let's take away the exemption, and you pay 40% on that. So it's quite unkind.
Now, I hear that inheritance tax is almost voluntary.
Yeah, you don't have to pay it if you
plan
it properly. You don't have to pay it if you plan properly and you know what you're doing there. So there's things you can do to avoid paying inheritance tax, or mitigate that, I should say. So the simplest thing to do, and this is if you're in good health, you can take out a life insurance policy that effectively pays off the tax on your death. That's the simplest thing to do. But there's also other things you can do. There's you can put things into trust. You can get a solicitor involved with your properties or whatever you like to put in there. And there's also investment products you can use as well. But there's different time limits and things you can give away. It's quite a complex area, actually. If you give something away, you need to live 7 years, and if you die within the 7 years, there's a tax.
Right, so let's clear this point. So the 7-year thing.
Yeah.
Just explain that in plain English.
Okay, the 7-year thing. So that was introduced so people wouldn't. So for example, we'll just use an example. Say I had a painting that was worth $1 million, and I was told that I had 2 years to live. I was like, right, here you go, Darren, have the painting. So to get it out of my state for inheritance tax. So the government was like, no, we're not having that. We're introducing the 7-year tapering tax. So if you give it away to Darren, and say if I die within 3 years, I don't pay as much inheritance tax on it, but it's tapered down a bit. So and then when you get to, there's a point where you don't pay any inheritance tax after the 7 years.
So basically, I
survive that period.
I could give you an asset, a gift
Yeah.
of an asset, and as long as I outlived that gift by 7 years, then you would not have to pay any tax on it.
That's exactly it.
Brilliant. Okay. All right. Look, I think it's a complex subject, the whole thing. I think inheritance tax, capital gains tax.
Yeah.
I mean, that sort of thing, really, people need to go and get some professional help. There is a couple of the websites to get professional help. You can go to Unbiased, we can go to Vouched For. Unbiased and Vouched For, good sites. You can go and search on there. You can talk to an advisor, you can have a chat on the phone, find out, how they can help you, what sort of money they can charge, that sort of thing. Definitely recommend that. As I say, this is not a promotional exercise for our company. We just want to share good content with people. So this is not an advert for Grace, for example, even though something.
I thought that's why I was on here. What's going on?
So we are at the end of the 30 minutes. I'm just going to do the wrap up of the 30 minutes. And now we've got quite a lot of questions. Lots and lots of questions. I thought we would actually. So I'm just going to share screen again and just tell everybody about. So that's the end of the official half an hour session. I've got brilliant. Okay. So next week we are. Sorry, there isn't anything next week. That is the last one. Going mad. So thanks for joining on this one. We will be doing podcasts. Look out for the podcast. As I said, look out for the go onto YouTube, Financial Fitness Fridays, and have a look at all the old ones on there. That's brilliant. And if you have to go now, good luck to you on your journey to financial well-being. Please give us some feedback. You'll be taken straight to the feedback survey. Give us that feedback and tell us what you'd like to see in the spring series. I have to put on the caveats there. That's for legal requirements. I'll do that. I'm going to stop the share. Most people are still here, actually, Grace. So I'm going to look at some questions. Okay, question. Where can I sign up for Financial Friday talks and podcasts, etc.? So everybody that's registered ever for a Financial Fitness Friday, we will let you know. That we're looking at where we host the podcast. So I think there is places you can host them, or they'll end up on iTunes and stuff like that. So if you've ever registered for a Financial Fitness Friday, we will get something out to you, no problem at all. That's good. So someone said, can I give away my family house and then outlive it by 7 years and there'd be no tax?
Oh, it's not as simple as that property. Will you be living in the property? That's the question. Because what a lot of people,
assuming. Yeah,
what a lot of people try and do, they try and do this. They try and give away their property, but they live in it. So if you're still living in it, you haven't actually given it away. It's what's called a gift with reservation. To put this simply, if I gave Darren a car, but I was still using it, I haven't actually given it away because we're both still using it. So it's not that simple, and the tax know that what you're trying to do. If you were to do that and essentially give away your property, you'd have to pay market rent for that property to live there, to stay there. So it's quite complex, and quite often this is something you get solicitors involved with actually, because it's not that easy, or else everyone would do it, unfortunately.
Brilliant. So I've got another question about pensions again, actually. So it says, what's the maximum threshold for tax relief on the amount you put into your pension? I think it was around 40,000 is the question. So could you just explain that a little bit?
Yeah, 40,000 is a gross amount you can put into your pension for tax year. So that's not.
Does that include employer contributions?
Yes, it does. It does. Now, something that's if you own if you own your own company, it's a bit different because it's corporate, but we won't go into that at the moment. So yeah, 40,000 is the amount you put in, including employee contributions for tax year. Unless you earn a lot more, and then you might be able to do a carry forward calculation. You haven't used your other years, and it's called carry forward, but you're actually going back. So
let's just try and make that point. So if somebody's used up all their allowance for that particular year, they can go back and use unused allowances for previous years.
Yeah, if they earn enough money to do that as well, they have to be over that as well. So it's not. Yeah, they should. It has to be over a certain amount of money for them to do that.
Okay. And what about if people earn seriously big money? I hear that the amount you can pay to pension comes down.
Yeah, if you earn over 250,000, unfortunately, you taper to £4,000, which is not so good. And a lot of people have no idea about this, which isn't nice at all. But and the other thing is your income tax, your personal allowance. You lose that when you're over £125,000, which is important to note. So the now 12,570 allowance disappears. But if you wanted to make that up, you can make a pension contribution. That's the easy way to do that for your employer.
Okay, brilliant. Really good question here from somebody. It says, do those of us benefiting from salary sacrifice, which I'm assuming they mean for their pension contribution, do they need to do anything to get the full benefits, or is it automatic?
The full benefits as in?
Tax relief.
The tax relief, that's automatically done for your employer. So that will show from that point. It's a bit different when it's done for your employer to if you do it individually. That's the issue. Your employer should take care of that, shouldn't they, Darren?
Yeah. So what we're saying there is,
your
using salary sacrifice into their pension, effectively, they've not technically made a personal contribution. Therefore, they will not need to complete their self-assessment to go and claim the extra tax relief. Because when they pay, if they're a high rate taxpayer, they only get basic rate tax relief when they pay it from their net pay. When it's salary sacrifice, it's deemed as an employer contribution to the pension. All the tax relief taken care of straight away. No admin for you to do something.
So do it for your employer is the answer to that question. That's easier for you.
Question about ISAs, which I think we might have covered, but ISAs are a very low rate. Is it worth it? What other better returns and less avenue savings are there? So I think there's a bit of a misunderstanding there.
Yeah, well, the thing is of ISAs, a lot of people just think you can get cash ISAs, don't know about the equity one. But and saying that with the stocks and shares,
equity one.
The equity stocks and shares.
In plain English.
Sorry, equity stocks and shares. Sorry, interchangeable. But in order to get one of those, we should really look at your risk, your attitude to investment risk, because you might not want to take a little bit of risk or have any stocks and shares, or you might be quite high risk, and that's fine. You can go in there. But I do have a lot of clients that are quite happy with bank accounts and they don't want to take any risk whatsoever. So. Okay,
brilliant. There's another good question over here, actually. Just again, good question because you clarify a couple of points. Inheritance tax is based on the estate, not just your property, isn't it?
Yeah, everything. So the best way to look at this is, apart from pensions, actually, and that's why they're so good as well, they're free of inheritance tax. So that's why when we recommend things, we usually say take your pension last because it doesn't form part of your estate for inheritance tax. So everything you've got, they throw in, they add up, and then they take away any liability. So if you've got a mortgage, they take that away. So everything. I've had clients who've had very expensive paintings that they've had insured. They'll know that. They'll take that off there as well. So everything in your estate minus your liabilities, but not including the pensions that are in that tax wrapper.
Okay, fantastic. It's an interesting question, actually. Oh, by the way, just for my team, the marketing team, I believe you're on the session. Somebody's asked if they could have the names of the two websites I referred to, so Unbiased and Vouched For. Would one of you just kindly put that into the chat box, and anybody needs to grab that can then grab that out and go and have a look. So that's for Valeria and Sophie, who I think are on the session. If they don't do that, if they're not on it, and I'm sure they are, but if they're not, we'll follow that up and send it out to people. Okay, so it's an interesting question. Is it worthwhile to put pension savings into a lifetime ISA where there is still tax relief, but there is very low interest rate, less than 1%? Again, same thing.
No, I mean, the thing is, I always say to have like eggs in lots of baskets and not just in one. The good thing about that is if you access it, and a lot of clients would rather, a lot of people want accessibility over the tax relief. And if you're buying a property, obviously that makes sense to do that one as well. The pension, the good thing about that is you can't touch it to age 55, although they're probably going to increase that age. Whereas anything in ISA or investments you can touch whenever you like. So if you're a kind of person who wants to go and spend and save, save money, it's a bit harder for you then.
Yeah.
Get a hold of it easier.
So the team has put the websites there for anybody that's interested. The Unbiased and Vouched, you can copy and paste those into your browser. You might end up finding in Grace anyway, because I think Grace is registered for both of them. So you might end up talking to her anyway. You never know. You never know your luck. This is another good question. Really important to sort these things out. Somebody say they've got a property worth £800,000, 4 children. Does each child get the full inheritance allowance?
Well, everybody has their own 325,000 allowance. So I'm not sure what. So
I think the question is
marriage.
No, the question is. I think the question is, does each child get 325,000?
Yes. Everybody's got it.
No. When they receive it, not when they give it.
When they.
£800,000 property, £200,000 each. Does that mean no tax?
There's no tax when they receive it, but they also get, there's no tax when, so if someone dies and they leave them that tax is paid by the estate, not the only thing.
Yeah. So the question is there a nil rate ban for each kid?
Oh, no, because it's their estate, it's not the kids.
Correct. So just not per.
Don't bother in the end.
I know. I know, but it's a bit nervy when you're on something like this. I appreciate it. It kind of makes your brain not work as 100%, 99%. But yeah, so the clarity there is that the £325,000 nil rate ban is per person's estate, not per inheritor.
No,
so you don't get 4 of them because there's 4 children.
Exactly. No, you're not that lucky. Sorry. Nobody's thinking to do, or she.
Okay. There's quite a few will questions, which I think it's not fair to put you on the spot because that's really a lawyer's job. We know basics for wills.
Well, it's quite interesting because one of the things that clients often ask me is when someone dies, they want to change things in the will, and you've got from 2 years of the date of death, you can do a deed of variation. So you can actually change the will of someone that's passed away if you wanted to. So it's a very interesting thing because a lot of people that say the estate leaves you the property in cash and someone wants the cash and not the property. You do have 2 years from the date of death to do that. So that's very common.
Oh, right. And that's the main reason for doing that?
Well, for example, what they might have done is they might say, we want to split the property and the investment. Someone might say, well, actually, I want the property, I want the investments. Can we just change it? So they just tweak it a bit to make it right for them.
Okay. Any more questions? I'm trying to find questions that's going to benefit the whole audience rather than there's a lot of very personal ones. And I knew there would be. So we'll try to answer those individually, pick those up afterwards. Okay. I think, let's have a look. Do you know much about premium bonds?
Yeah.
Okay.
What do they need to know? What do they want to know about premium bonds? You get 50,000 limit for premium bond. The interest rate's not high, but still with your prizes that you get that are tax free, hopefully you win the million, and it still ends up being about 1% with the prizes you get, give or take. So it's not a bad thing to do. It's good for your emergency cash. Brilliant.
Thank you very much. So the bottom line is, most people are not taking advantage of all the tax reliefs and allowances they're entitled to. I think a common mistake is the lifetime ISA and the tax reliefs. Can we just explain that very simply before we wrap up? I think that's just good for people to know how the tax relief works in a lifetime ISA.
The lifetime ISA in relation to properties, Darren.
So you have a lifetime ISA. It's an ISA that you get tax relief.
The 20% that you get, the tax relief on that the government adds to it.
Yes, tell everyone a bit about that.
Yeah, well, it's a lifetime ISA. The government adds 20% tax relief, and generally that's to be used for you buying a property or when you retire. So that money's added. So it's meant to be used for those specific purposes. Now, the limits aren't as high. And actually, there's not a huge take-up on there. I have to say, I don't have a lot of clients that do them.
Right, okay. And is there a limit how much people can pay into them? Is it different to...
I think the limit's 4,000.
Oh, hang on. Yeah, you're right. Actually, I've just seen the notes here. 4,000 pounds. So
4,000. Yeah, I had a blank. 4,000. So it's not a huge amount of tax relief you get on those anyway.
No, but they're useful for young people, I think, trying to save for a deposit on a property.
Yeah, well, 20%, and if you're going to use it for a property, it's a good idea. That's another good thing for you, for young people, because it looks like they're going to have to only put down a 5% deposit this latest budget, which is good.
Yeah, so this is like a new thing on top of the Help to Buy scheme. Which is only for new properties, really. So this is another new thing, which is good. Yeah, so young people have got a bit of... The only worry, I think, whenever these sort of things are introduced, like stamp duty holidays or some kind of deal which helps people get a mortgage easier, lower deposits, they tend to put the prices up of the property because the demand goes up. But anyway, we can't.
What's going to happen in 6 months to a year? Prices might go down again if, unfortunately, there's a lot of redundancies and people made unemployed, that kind of thing. So it's...
Yeah, somebody has just mentioned lifetime ISA. So there's a couple saving for a property. They're two ISAs, tax relief twice. You can get to the deposits a lot quicker, and now that you don't need as much. So all good news, really. So look, I think we're done. Thanks very much, Grace, for jumping on.
Well,
thanks everybody.
Thank you for having me.
It's all right. It's been a pleasure. What I'm going to do is, for those of you that have asked questions that we can't answer, we haven't answered just yet, we'll endeavour to pick those up for you. Yeah, there's a whole load more coming since we mentioned lifetime ISAs. Okay, so we will pick those up, but we are at the end of time now. So thank you very much, everybody. Look out for the next series. This is going to be in the spring. Watch out for the podcast. We'll promote it and let you know all about those things. And I hope you get something out of it. We always say, whatever you do, go and get professional, regulated advice if you can afford it. People are better off when they pay for advice than those that don't. So it is difficult to get hold of. But please do that. And when you come out of session, please give us some feedback. Let us know what worked today for you. Tell us what didn't work, and if you've got any suggestions and anything you want to see in the next series in the spring, please let us know, and then we'll take the most popular ones and then we'll pick that subject and we'll get cracking in a couple of months. The clocks are going to go forward. Is that right? Yeah. Spring forward. Okay, very soon. So we'll have longer days, sun shining. I think we've got light at the end of the tunnel. So happy days. Good luck to you all, and best of luck to everybody on your journey to financial well-being. Thanks again, Grace. Take care, everybody.
Bye. Bye, everyone.